Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at ratios across the board, see what's doing well, see what's not doing well, see how these assets are moving against each other. We'll see some definite ones that are progressing forward like gold. They've done very well and it's done well against other assets. So we'll go through a bunch of different ratios. I'll give you my financial opinions around it. We can figure out what's cheap and what is improving or not improving, and what has changed over the past few weeks with all this fear in the market. So this is what I use for at least for my buy points and sell points is ratios. And this is where I start looking at certain sectors of what I think is good or cheap, I should say. And just because something's cheap does not mean that it has to appreciate immediately. It just means that under the right market conditions, these assets will get repriced differently. And since we've had a lot of fear in the markets, assets have gotten priced differently. And I'll show you that with gold especially. All right, so let's dive in here. Let's take a look at what we've got. I'm going to start with just the most basic one, the commodity to stock ratio. And we do go over this quite a bit. We've got this downtrend line from circle to circle. This is the top, this is the bottom. We've entered a new paradigm where commodities will outperform going forward. And I think that this is the first wave. This is the first pullback that we're getting in the ratio since about, was this 2022, late 2022. That's kind of our first pullback here. Now, a lot of people say, well, why don't we just sell here and buy it when it bottoms? Problem is, I don't think anyone knows the exact top or the exact bottom. That is the problem. So what I do, at least my strategy, is I bought down here and I've just been waiting. I've been holding on, and I've accumulated along the way various sectors that are cheap, and I'm going to continue to accumulate, hold the bull market. So it's hold the rips, buy the dips is my strategy, at least. I know some people don't like that strategy. They think they can trade their way to success, and that's up to them. If they want to try to do that, that's up to you if that's the strategy that you want. But right now, if we kind of zoom in on the commodity to S&P 500, we've had this downtrend channel that we've broken, and we've recently pulled on back to do a retest move. Will this rocket higher, or is the fear in the market and all of that stuff going to reprice this differently? Generally speaking, given where we are in this kind of market conditions, what's going on in the United States housing market and stuff, I still think that commodities are going to outperform the S&P 500 in an inflationary environment with a credit expansion phase in real estate. Now, I know that's slowed down some or a bit, and that is something that we still have to continue to monitor to ensure that those market conditions remain ripe for commodities to outperform the S&P 500. But we have printed money recently. That is basically, I'll call it bailout money or whatever you want to call it. And we have seen a rapid increase with the assets purchased on the Fed balance sheet. So that is generally inflationary, and that's what gold is also repricing in, is more money printing. So let's keep going. We're going to go down into other ratios. So here's platinum to gold ratio, big picture view. Platinum is more inflation sensitive than gold is. So under an inflationary condition, you'll see gold start to outperform. And I think that's what's coming ahead of us, is an inflationary condition, because the platinum to gold ratio is signaling that we've broken this downtrend and we're still doing one massive long retest. Now, recently, with the fear in the market, gold has been outperforming platinum. You can see that here with the fear over the last some weeks before it and after. But the ratio is still very favorable for platinum to outperform gold in the future when the right market conditions are present. This here is a big, decline in the ratio, and I think it will bottom at some point and work its way on higher under an inflationary environment. We've got platinum to palladium. I think platinum will outperform palladium, and platinum is incredibly cheap in relationship to palladium. 0.7. So I do think that this will continue higher. It won't just go straight higher. Just be patient with it. But it could do something like this. We peaked out at about 5.5. This is about 5 here. Those would be really good times to offload platinum for palladium and get 5 times your metal. Now we're at 0.7. And that means that you're going to get a return that's over 5 times as much palladium if you buy platinum today. That's how cheap it is. We're at, I would say, a very low ratio, and it's great for platinum. Platinum to silver ratio, this is broken out of its declining or falling wedge. Generally, that is bullish for platinum to extend higher because we've got the breakout. But the market conditions the past, I'd say, couple, week or two have been favorable for silver. The fear in the market and the normalization of the yield curve drives gold and silver higher. Platinum's more of an inflation type of guy or girl, however you want to say it. It likes inflation, and in inflation right now, people are scared. They're selling off oil. They're selling off the inflation hedges. Now, platinum is it's basically very similar to oil. So if you think oil is going to go up, more than likely you think platinum's going to do well as well because it's inflation sensitive. But right now, silver is beating it in the short term. But I do think platinum will do well when the right market conditions come up ahead of us. They're going to solve all these crises, most likely with money printing. Any problem they have, print money. That's basically all they can do. And the system, if it's a big Ponzi scheme that a lot of people think it is, and I think it is too, you're either inflating or growing the money supply, or you're collapsing the system. They're not going to let the system collapse, in my opinion. I think they'll just print money. And all of that pressure will manifest itself in the currency itself. And this is what protects you, in my opinion, is platinum. We've got the gold to silver ratio. We've got very cheap silver up here. And again, we're at cheap silver, and it does look like we could potentially turn and head lower for this gold and silver ratio. You can see a large move lower, and it looks like it's ready to break to the downside for this ratio, meaning that silver is going to outperform gold. So if the right market conditions persist, and I don't know how long those market conditions will persist, silver would be the one that I would be looking at right now. Gold is also very, very good. Both of them. Palladium to silver. These are more of the extremes. Palladium does well in a disinflationary environment. We are not in those market conditions because the palladium, I would say, is more or less the metal that you want with a NASDAQ or a S&P 500 market conditions. And I'm not a big fan of palladium at this time because of the market conditions. And I think this will continue to go lower where silver is going to outperform palladium. I also think platinum will outperform silver as well, or platinum will outperform palladium. So this is falling. And if you're a big silver holder, I think that you're going to outperform palladium very much. And I think we can get down to a ratio of 20 or below, or 30 below, so something like that. And that's where I would start to look to swap my silver for palladium when the ratio gets that cheap. Dow Jones Industrial Average versus gold, the Dow to gold ratio. This is a very popular one. You can see this is where Dow does great, gold does great, and so forth. So that's the ratio there. We've come on down, we've pulled on up, and now we're starting to compress that ratio to the downside again. That compression is signaling that gold can outperform the Dow Jones Industrial Average here. It's also signaling that the market conditions is for a commodity bull market. So if we look here, this basically came and broke down in the year 2001. And then we've come all the way down and bottomed where basically the stock market in 09, 2010, 2011 bottomed. Stocks were preferable here, and then I think we are going to come into an area where we're going to get another commodity bull market, and gold's going to outperform the Dow Jones Industrial Average. We've got gold to oil ratio that is shooting higher. We're at about 30. 30 is an incredibly cheap ratio, where if you look back in history, there wasn't that many times in history where we've had a ratio this cheap. What that is signaling is that as gold progresses higher, oil becomes cheaper if it doesn't move. If it moves lower, then oil is becoming even a better buy. 30 is that threshold point where I consider oil to be incredibly cheap and at a buy point. So when looking at this ratio, this is signaling that we should be looking at oil and be looking at a momentum shift whenever this turns, to be looking for a buy point in oil because of how cheap it is. The copper to gold ratio is falling right now. So gold is outperforming copper. And you can see how this guy basically is a flag pattern that's breaking to the downside. What that is signaling is that there's fear in the market. When there's fear in the market, gold generally outperforms copper. And we could see this fall further depending on how much fear is in the market and how that market's going to price these two assets against each other. But right now, this is definitely signaling that we've got fear in the market, and it could potentially fall lower. The Baltic Dry Index in relationship to gold, we are heading higher here in the short term the past few weeks outside of last week. But we are at a very cheap ratio for the Baltic Dry Index in relationship to gold. Very, very cheap. Historically, this is like an anomaly down here in this general vicinity. So the Baltic Dry Index is really, really cheap. And then looking at the Dow Jones Industrial Average to crude oil, and I put this in here thinking that we were going to hit somewhere in this orange bubble because we were down here, and we're going to come up and eventually work our way back lower, just like we did in 1998. It came down, broke the downtrend, came up to a level that, let's put a horizontal line there. That's where it peaked last time. We could come to this horizontal line and bounce back down. That's kind of what I'm thinking is going to happen, which means crude oil could underperform the Dow Jones Industrial Average in the very short term, creating a very good buy point for crude oil and the companies that sell crude oil. We're also going to look at crude oil divided by natural gas. So this is another ratio, and we're at a very cheap ratio for natural gas. We're at 28.3, very similar to the bottom of 2020, where that compressed down, and cheaper than anything in history before these bull markets. And some of these bull markets, they compressed down to 2.79 in 2001, 4.5. The energy content for crude oil to natural gas is 1 to 6. And these guys way down here are very large compressions. Up here, natural gas is cheaper than all get out. So we're at a very cheap area for natural gas. We're at a very cheap area for crude oil, making natural gas one of the cheapest assets in the world at this moment. Platinum, natural gas, and some of these other ones are incredibly cheap. Let's look at crude oil in relationship to gold. This is just flipped. I know we do a lot of gold to crude oil stuff. One thing I want to say here about crude oil, because we think it's pretty cheap, at least I think it's cheap. This is an uptrend where crude oil outperformed gold. This was a downtrend where gold outperformed crude oil. Think of this as more or less imbalances in the asset versus each other. And right now, we have broken out of the downtrend pattern for crude oil to outperform gold. And now we're doing a retest move back to a very long-term trend line for crude oil support. And we could even go a little bit lower if it wants to dip. I think we're at an incredibly good buying opportunity for crude oil. I think that crude oil will probably be one of the best outperforming assets, along with uranium as well. Uranium, crude oil, and natural gas right now. So I think the natural gas and oil companies provide pretty good entry points very soon. Depending if you're an aggressive investor, if aggressive, I would cost average in very slowly. If you're ultra conservative, I'd wait for the bottom and buy into strength. So we're still early in that game, and we could still see some more downside for crude oil. One observation is crude oil in relationship to gold. There's only been a few times in history that it's been cheaper than where it is today. A few times in history. I mean, obviously in 2020, that was a great buying opportunity, and we have a little bit of a spot in 2016. But I still think the market conditions are right for crude oil in the future to appreciate, and I think we're going to have a pretty good buying opportunity here in the short term. So that's what we've got right now in the markets in terms of ratios, looking at a lot of different commodities. You can see the ones that I think that are cheap: natural gas, crude oil, and platinum. I also think silver could do some crazy stuff, and gold, given the market conditions of where we're at, and looking at the potential normalization of the curve. And I don't know if that curve's going to normalize for a long time, or if it's going to be short-lived, or if we're going to re-invert the curve later in the year, depending on the decisions that the Federal Reserve makes in terms of QE, money printing, and all that type of stuff. So that's where we are. Generally, gold is the leader. It'll run out of the gates if it smells money printing. They definitely increase the balance sheet of the Federal Reserve. They're increasing the money supply by doing that. And they went from QT to QE in basically 0.1 seconds. If they're doing QE, I'm not calling it QE. I'm just saying they're reliquefying parts of the system. Gold is pricing that in. And generally, oil lags gold in the beginning of these markets. And gold or oil will eventually catch up because it's a good inflation hedge. It's one of the most inflation sensitive assets, along with platinum out of the precious metals group. But that's what I've got for today, guys. Hopefully you enjoyed it. Give me a thumbs up. Subscribe to the channel. Definitely check out finding-value.com. Check that out over there. Become a platinum member. Use the word discount if you guys want further education, further information on these markets. But that's what I've got for today. Thanks for watching. We'll catch you next time. This is Finding Value.